And in this video, we're breaking down 3 key differences and 2 surprising similarities between stocks and cryptocurrencies. Stocks are seen as the reliable backbone of traditional finance, while crypto represents a new frontier, innovative, fast-moving, and full of potential. But despite some notable differences, both can, and some say, should have a place in modern, diversified portfolio. First, let's talk about the assets themselves. And one of the most fundamental differences, what you actually own. When you buy a stock, you're buying a small share of a public company. Its value is usually tied to immeasurable things like revenue, profits, and assets. Analysts build detailed models to project these numbers into the future. But a stock's price isn't only based on today's data. It often reflects the market's belief in future growth. If investors think that a company will grow, the price rises. But the reverse is also true. Even if a company looks strong on paper, its stock can fall if people lose confidence in its future or in the industry overall. Now, crypto is different. You're not owning part of a company. You're owning a digital asset that plays a role in a decentralized network. Both stocks and crypto have value because people want to own them, but the reasons why are very different. In crypto, the first key driver is utility. Take Ether, for example. It's essential to the Ethereum network. Developers and users need it to pay transaction fees, run applications, and interact with smart contracts. Second, there's scarcity, sometimes called tokenomics, and Bitcoin is a classic example. Its supply is capped at 21 million, which is why it's often seen as a digital gold and a long-term store of value. And finally, there's community. In crypto, the strength and passion of the community behind a project can be a major force. You'll see it in stocks too. Think Apple versus Microsoft loyalist. But in crypto, this effect is often a core driver of the asset's value. When a community actively uses, builds on, and advocates for a project, it creates powerful network effects that directly influence its success. And sometimes that belief alone can drive price even more than the underlying tech. Now let's talk about how you actually trade these assets, because this is where the differences directly impact your experience. Stock markets have a long history, going back to the 1600s. Today, most stock trading is digital, but it still runs through centralized exchanges with fixed hours. In the US, that means Monday to Friday, from 9:30 a.m. to 4 p.m. Eastern Time. Crypto, on the other hand, was built for the modern age. Since Bitcoin launched in 2009, crypto has existed entirely online. It's borderless, decentralized, and always on. The crypto market runs 24/7 every day of the year, no opening bell and no closing time. Where and how you trade is also very different. With stocks, nearly all trading happens on centralized exchanges like the NYSE, using brokerage platforms. But with crypto, you've got more options. You can use a centralized exchange like Binance, which matches buyers and sellers, or you can use decentralized exchanges or DEX. These are platforms built directly on the blockchain with no central company in charge. You trade directly with others through smart contracts, which automatically complete the transaction once both sides agree. And there's even a third option, peer-to-peer trading. This means dealing directly with another person. It gives you more control and can help reduce exchange fees, but it also comes with more risk. That's why many users choose Binance's P2P platform, which connects buyers and sellers, holding funds in escrow until the trade is complete. One more key difference is settlement time. With stocks, even if your order is filled instantly, the actual settlement can take days. But with crypto, settlement is usually near instant because transactions are confirmed directly on the blockchain. This always open market gives crypto traders more flexibility, but it can also lead to more volatility. Prices can shift at any hour of the day, reacting in real time to news or global events. But with stocks, prices are mostly frozen outside of the trading hours. Our final key difference is the rulebook. Stocks operate within long-established regulatory frameworks, and public companies must follow strict disclosure rules, publish audited financials, and comply with authorities like the SEC in the US. Crypto began in a very different environment. In the early days, there were no specific regulations, not because of oversight failure, but because the entire concept was completely new. Well, that was then. Today, crypto is entering an even more mature phase. Governments around the world have established frameworks to regulate digital assets and improve user protection. The EU's MiCA regulation is a recent example designed to unify standards across all member states. Global standards for anti-money laundering and identity verification are becoming even more consistent, and countries that once dismissed crypto are now even exploring official use cases, from central bank digital currencies to crypto-based investment funds. While global regulations are still developing, the direction is clear. Crypto is moving toward a more accountable model. And while the rules might differ from the stock market, the goal is the same: to build trust, protect users, and create a safer environment for everyone. Okay, we've covered the differences, but where do they meet in the middle? One interesting way is accessibility. One of the best examples is how both are becoming available in the same places. Traditional brokerages and even some banks now offer crypto trading alongside stocks. That's made it easier than ever for people to access both asset classes from a single platform. And it doesn't stop there. The launch of spot Bitcoin and Ethereum ETFs have brought crypto into the world of traditional finance in a big way. These ETFs trade on regular stock exchanges, but their underlying assets are crypto. That means investors can gain exposure through a familiar route without setting up a wallet or managing private keys. It's a major step towards mainstream adoption, and it shows that the gap between traditional markets and crypto is getting smaller by the day. And that brings us to our second similarity. These two markets are more connected than ever. Plenty of well-known companies have seen their stock prices move in response to crypto activity. Tesla and PayPal are two clear examples. Whether it's a Bitcoin purchase or a new crypto product, sometimes even a rumor that a company is entering into the space is enough to move the markets. Then you have major crypto companies like Coinbase and Marathon, which are now publicly traded. Their stock prices seem to rise and fall with the crypto market, but it goes both ways because they're included in major ETFs and indices, and their performance can influence broader stock market movements. That means that if crypto prices fall, even equity portfolios with no direct crypto exposure can be affected, simply because they include companies whose stock performance is linked to the crypto market. And the same is true on the upside. A strong crypto rally can lift the value of broader funds and indices by boosting those same stocks. Institutional adoption has only deepened the link. Strategy is the most well-known example, but it's not alone. Public companies, hedge funds, and even sovereign wealth funds are adding crypto to their balance sheets as part of a long-term investment strategy. It's a clear sign that crypto is becoming part of the same global financial system that moves traditional markets. And as adoption grows, both asset classes are reacting more similarly to the same macroeconomic forces. Interest rate hikes, inflation data, and geopolitical headlines often move both markets at the same time. The point is, crypto and traditional finance are no longer separate worlds. They influence each other in real time. And what happens in one market can have a real impact on the other. Despite their differences, stocks and crypto now share more common ground than ever, and both offer real growth potential. Both respond to global events, investor sentiment, and shifting market trends, and both carry risks, just in different ways. Crypto may still be navigating early-stage challenges like evolving regulations and technological uncertainty, but stocks come with their own risks, tied to economic slowdowns, interest rates, and global market cycles. So comparing the two isn't about choosing a winner. In fact, it's their differences that make them valuable. The key is to understand what each one brings to the table. Stocks give you ownership in established companies. They offer structure, history, and long-term performance based on business results. Crypto gives you access to emerging technology with open access, rapid innovation, and the potential for high returns as adoption grows. And that's why today's investors aren't choosing one or the other. They're using both strategically to build stronger, more diverse portfolios that look to the future. So what's your strategy? Do you trade stocks, crypto, or a mix of both? Drop your thoughts in the comments, and don't forget to like and subscribe. We've got plenty more videos coming up your way, so thanks for watching, and we'll see you in the next one.